nail right on the head. I mean, we're looking for a 4.5% decline in S&P 500 earnings in the third quarter or thereabouts. If they come in slightly better than expected, as was the case in the first and second quarters, as you say, that's good. With respect to the trade deal, it's interesting that there's so much optimism that if the Chinese were just to begin purchasing agricultural goods, which they have not bought since last November in bulk, it just puts us where we were before the trade war started. So, yeah, de-escalation is good insofar as it doesn't get worse from here and the tariffs don't go to 25% on $600 billion worth of Chinese
Ishwar
goods.
was interesting there where he said basically a lack of escalation equals de-escalation.
More precise.
Right?
Yeah.
A lack of escalation. So, Will, after we stop worrying about China trade for a week or so, what's the next worry for the market?
I think the worry for the market is the slowdown. I think, as people have said, trade tariffs aside, it doesn't change the fact that the global economy, is slowing, and people are worried about what the implications would be for the U.S. economy, particularly when you're coming into third quarter earnings season.
So, if you get some sort of breakthrough on trade, does that mitigate in any way? And we've looked today at copper and some of the industrials and so forth. Does that mitigate the economic slowdown globally?
I don't know whether it mitigates it, but it certainly would help because obviously, global trade, China and the U.S. being the two biggest players in that, I think that only helps the situation. But I'm not sure that it's enough.
To counteract that. Exactly. That's the heart of my question.
Well, what's interesting, and it's kind of subtle, if you look at global interest rates, they're not as negative as they were 2, 3, 4 weeks ago. You've seen German Bund rates come back under minus a half point. You've seen Japanese rates rally back. You've seen Swiss rates rally back. Copper, as you say, is up. We're seeing very small hints of optimism in those markets.
The U.S. 10-year is up a little bit.
Yeah, 175 almost now. So I think that's a sign that there's a little more optimism in the bond market where there's been a notable lack. So it may not be fully important, and certainly the Fed, with some of its machinations of late, is helping to steepen the yield curve, but it's a better sign than not.
It took a lot, though, to get us higher on the S&P 500 by 48 points. I mean, it took the partial deal. It took a Brexit breakthrough. It took protesters possibly considering winding down protests in Hong Kong. I mean, all these things had to come together in order to give us 48 whopping points on the S&P 500. Well, so how do you... Is it really the global slowdown ultimately that's going to take hold? And if so, I mean, isn't the risk reward to the markets to the downside now that we're 1.5% away from all-time highs?
Yeah, I mean, there's just so much short-termism. People looking at every machination of this on a daily basis, and as we started talking about at the beginning, trade deal off, on, market up, down. I think people have kind of lost perspective a little bit on the bigger picture, which is, what does the market look like, over the next 10 years, and what are these kind of key things there? And I think the lens of, technological disruption, for example, affecting all companies kind of around the world is something that people aren't really focusing on as they look at, just the short-term, to's and fro's of what's going on.
I wish there could have been a follow-up question to Treasury Secretary Mnuchin, who said the stock market is always right. Stock market has gone absolutely sideways since January of 2018. It's been 20 months where we've only made nominal new highs with no meaningful breakout. I'd like to know what he thinks that means relative to a 400-point pop in the Dow today.